Warren Buffett once said that the secret to successful investing is to buy when people are fearful and sell when they are greedy. Today, we are looking at the VIX, a tool that may very well help you make those Buffett-inspired decisions, and we will begin right now. VIX is the ticker symbol for the Chicago Board Options Exchange's Volatility Index. Holy banana bread, that is a little bit of a mouthful. So luckily, we can call it the CBOE Volatility Index. This is a measurement of the expected 30-day volatility of the S&P 500. It is one of the more reliable methods of judging how much fear is in the market. The speed of how fast prices move is what we call volatility, and overall market volatility tends to increase when there is more fear in the market. The speed of how fast prices move is what we call volatility, and overall market volatility tends to increase when there is more fear in the market. The VIX is widely used by everyone from financial media to investors as a solid market indicator. Before I tell you how the VIX works, tell me below in the comments if the VIX is new to you. Also, if you are new to the channel, or one of those folks who watches all the time but hasn't yet subscribed, yes, I am talking to you, Brian, please click on the subscribe button. It's absolutely free and it helps the channel a ton. In understanding the VIX, you need to know a wee bit about options trading. In a nutshell, options works when someone makes a contract that predicts the price direction of a specific asset. If they think the price is going up, it is called a long. If the price is going down, then it is called, well, yeah, you got it, a short. Someone will then buy that contract and pay a premium, which is basically a fee that goes to the person who wrote the contract. An increase in volatility will result in that premium charge to become more expensive because there will be an increased need for options. The reason for this is that in a more volatile market, the price moves more, which makes it easier for a contract to be executed if it hits the agreed upon strike price. The writer of the contract, of course, hopes that does not happen because they want to make their premium and then buy or sell the stocks in the contract at a profit. With that high volatility, it is easier to hit a strike price, which is one of the reasons why options are in a higher demand in a volatile market. As a result, the writer can then charge more for the contract, and if that strike price is hit, they're still getting that higher premium, but then they do have to buy or sell the stock in the contract as a loss. Now, one thing to keep in mind, it is not the options that causes the volatility, but rather the volatility causes the premiums to increase in price. This price change is reflective of the overall fear in the market. Volatility, as you probably have figured out, can be caused by black sheep events or just general world events. Because of this increase in option prices with volatility, the VIX can use that data point to derive its value. When the market is more volatile, the VIX is higher, and when the market has, of course, lower volatility, the VIX is thusly lower. All right, in a nutshell, the VIX estimates the expected volatility of the S&P 500 by aggregating prices of multiple puts and calls, those are those strike prices, within SPX options. What we are left with is a numerical value that begins at 0 and, well, yeah, theoretically can go all the way to infinity, though it is usually much, much, much less than infinity. In fact, the average VIX value ranges from 13 to 19. At the time of this recording, the VIX is at 28.5. Interestingly enough, back in March 2020, we saw the VIX spike to 79 with the pandemic. So what does this all mean? Going back to Warren Buffett, this is simply an indicator that can help you determine if there is fear in the market, and thus, well, a good time to buy. The higher the index goes, the better the buying position for high conviction blue chippers. Conversely, if you are looking to sell or take profits, the best time will be with a lower VIX number. The VIX overall tends to rise when the S&P falls, and then the VIX falls when the S&P rises. It is not a perfect negative correlation, but it is more than reliable enough to be used as a regular tool. If you look at this graph I pulled off of Yahoo Finance, you can see how the VIX moves in comparison to the S&P 500. This is a 4-hour chart, and you can notice that the negative correlation is not perfect, but it is pretty darn good. Note how the VIX pumps when the S&P crashes. That does tend to be our best negative correlation points in the graph. Using the VIX as your personal fear and greed index is absolutely the best way to use the VIX for a long-term investor. When the VIX is high, it is time to buy. The VIX itself cannot be traded directly, but you can trade it via futures contracts, though that is not something we will get into today. There are also ETFs that trade VIX short-term futures. In the US, they have ProShares VIX short-term futures ETF with a ticker of VIXY, and in Canada, we have BetaPro S&P 500 VIX short-term futures ETF with a ticker of HUV. Both of these ETFs are high risk, and they have management expense ratios of 0.87 for VIXY and 1% for HUV. I am not going to say anything more about those ETFs other than to say, once again, they are high risk, and be sure to do your due diligence if those are ETFs you are interested in. Personally, I prefer the conservative path in a bear market, but there is money that can be made for those of you on the riskier side. When it comes to how I personally use the VIX, I pretty much know where the average is, and thus, if the VIX breaks above 20, I am looking at my high conviction stocks and getting ready to start adding to a few of my positions. Dollar cost average for the win, and my portfolio will be all the better for the eventual lower VIX days when the bulls come back to town. Speaking of great bull plays, you should check out my video on Canadian Western Bank, or you can try the video YouTube thinks you'll like. Your click will decide who's right, and I'll see you in the next video.